Hello everyone, welcome to Managerial Finance. In the first lecture, I would like to introduce several concepts of managerial finance and fundamental analysis. In this lecture, we'll introduce several things, and the first is the three major forms of business organization, and the second we talk about primary and secondary markets, and the third topic is agency problems and corporate governance. In chapter 2, and we are going to focus on fundamental analysis. Basically, we are going to look at three major financial statements. Income statement, using income statement to estimate earnings per share, the EPS, earnings per share. And we also using balance sheet to calculate book value per share. Is BVPS is book value per share. And we also use a statement of cash flows to calculate free cash flow and to estimate the company's intrinsic value. So the three different forms of business organization, including sole proprietorship, partnership, and a corporation. The disadvantage of a sole proprietorship is that they have unlimited liabilities, while corporation only have limited liability. Investor only be responsible for the money they invested in that capital. So corporation is the major forms of business, and when a corporation wants to list it in the financial market, it's going to go through a primary and a secondary security sales. So the primary market is typically we called new issue. Okay, is initial public offering, or IPO, and also seasonal offering, which is that the after IPO, if the company still need new fund and issue some new stocks. Keep in mind that primary market, the issuer receives the proceeds from the sale, while on the second market is the existing owner sell to another party. So the issuing firm does not receive proceeds and is not directly involved. So one of the important theory is agency theory. So the agency theory talk about the managers. The managers supposed to maximize shareholders' wealth, but in reality, the managers may act in their own interest and do not behalf on the owners or the shareholders. So we call this one is principal and agent problem. To solve that problem, a company has to have a good corporate governance. So the corporate governance can help control agency problems. Minus interest expenses and the tax you paid. So EBIT minus interest expenses and taxes, so you have net income. If the company has no preferred stock, So the earnings per share is going to be net income from the income statement divided by the shares of outstanding. So why you calculate earnings per share? Because you can use the earnings per share and times that PE ratio, okay, the price earning ratio, which is the number typically in that industry. Okay, a company has the same or similar PE ratio relative to other companies in the same industry. So using earnings per share to predict stock price. And the second financial form we using is balance sheet. So the balance sheet is going to include total assets. So the total asset part including total liability and the total equity. So the total asset is always equal to total liability plus total equity. So from balance sheet, so we can calculate book value, okay, or also we call it net worth. So net worth is total asset minus total liability, so which is equal to that total equity. Using total equity divided by the shares of outstanding, you got book value per share. We can use the book value per share times the market to book ratio and to estimate stock price. And another statement we might use is the statement of cash flow. The statement of cash flow including operating activities, investing activities, and financing activities. So you can build the statement of cash flow from income statement and balance sheet. Just look at the changes between different years of the income statement and balance sheet. Okay, this chart gave you a detailed steps how to calculate free cash flow. Okay, we're using that chart to calculate free cash flow in 5 easy steps. So follow these steps, calculate free cash flow for that company for each year. So what are we gonna use that free cash flow? Okay, here it is. So using free cash flow to calculate the intrinsic value of the company. So look at the formula in the middle is we get free cash flow in the first year and discounted by the WACC, which is the weighted average cost of capital, and plus the second year discounted and free cash flow, and it goes to the infinite. Okay, you sum them up and that's the intrinsic value of the company. So here we end our topics in this lecture. So we can using the financial statement to do fundamental analysis and determine the stock price and the intrinsic value of the company.